On the 5th of May, 2026, just 24 hours after American military helicopters had sunk 7 Iranian fast attack boats in the Strait of Hormuz and 2 American-flagged merchant ships had completed the first successful commercial transit. Under military protection since the war began on February 28th, Saudi Aramco released its official selling prices for June crude loadings to Asia. The numbers landed on trading desks from Singapore to Tokyo with the force of a strategic statement as much as a commercial announcement. Aramco cut the price of its flagship Arab Light crude by $4 per barrel, bringing it to a premium of $15.50 over the regional Oman and Dubai benchmark averages. The cut was smaller than the market had expected and smaller than most analysts had forecast. A Bloomberg survey of 9 traders and refiners had projected a reduction of $8 per barrel from the record high May premium of $19.50 per barrel, which had been the highest official selling price premium that Aramco had ever charged for Arab Light crude loading for Asia in the company's history as the world's largest oil exporter. A Reuters survey of industry sources had separately projected a cut of between $5 and $12 per barrel, with the wide range of $7 between the low and high ends of the forecast, reflecting how uncertain market participants were about how Aramco would approach the June pricing, given that the Strait of Hormuz was still closed, and only the Yanbu port on the Red Sea was regularly shipping out Saudi light crude to international markets. Aramco delivered $4 of the 8 that Bloomberg's survey expected, and framed the decision with no public explanation, which is entirely standard practice for a company that lets its price sheets communicate its market view rather than issuing accompanying commentary. But the price sheet on May 5th communicated several things simultaneously, and none of them were straightforward. It said that Aramco believed the supply disruption in the Gulf was still severe enough to justify maintaining Arab Light at a $15.50 premium over regional benchmarks, a level that remains near historically unprecedented territory even after the $4 reduction from May's record high. It said that the ceasefire talks between Washington and Tehran through Pakistani intermediaries had not yet produced the kind of breakthrough that would allow Aramco to assume normal supply conditions were returning anytime soon. It said that Project Freedom's first day of operations on May 4th, while producing genuine military success in defeating Iranian fast attack boats and enabling 2 commercial transits, had also produced Iranian missile strikes on the UAE that demonstrated the strait would remain contested for the foreseeable future. And it said that Aramco was watching the UAE's departure from OPEC Plus effective May 1st with the careful attention of a company that now found itself doing, in the words of Rystad Energy, more of the heavy lifting on price stability, with the market having lost one of the few shock absorbers it had left when Abu Dhabi walked out of the organization that Saudi Arabia had led for 6 decades. In the next few minutes, you are going to understand exactly what the Aramco price cut means for Asian buyers who have been absorbing unprecedented energy costs for more than 2 months, why the decision to cut by $4 rather than 8 reflects a specific and carefully reasoned strategic calculation about where the war, the ceasefire talks, and the post-OPEC energy landscape are all heading simultaneously, what the UAE's exit from OPEC means for Saudi Arabia's position as the organization's dominant price setter, and for the global oil market's ability to manage the supply surge that will come when the strait eventually reopens, and how all of these moving parts fit together into a picture of global energy markets attempting to navigate the most complex and consequential supply disruption in their entire history. To understand what Aramco's May 5th price announcement actually means, and why it was constructed the way it was, you have to understand the extraordinary and historically unprecedented pricing environment that the Iran war has created for the crude oil that Saudi Arabia ships to Asian buyers, and that has no real parallel in the modern history of global energy markets. Before the war began on February 28th, Arab Light crude loading for Asia was trading at a modest premium over the Oman and Dubai benchmarks, a routine commercial relationship reflecting the quality differential of Saudi crude relative to the regional reference prices that Middle Eastern producers use to price their exports to Asian buyers. The premium was measured in dollars and fractions of dollars above a benchmark that itself was tracking the normal supply-demand balance of a reasonably well-supplied global oil market. The closure of the Strait of Hormuz in early March, which removed approximately 20 million barrels of daily oil flow from global markets almost overnight, and forced Saudi Arabia to reroute its exports through the 1,200-kilometer east-west pipeline to the Red Sea port of Yanbu, created a supply emergency of such intensity and scale that it transformed the entire pricing arithmetic within weeks. By the time Aramco set its May official selling prices in early April, the disruption was severe enough and the alternatives limited enough that Aramco charged a record high premium of $19.50 per barrel over the Oman and Dubai averages for Arab Light loading in May, a number that would have seemed literally impossible to any oil market analyst reviewing Saudi pricing history before the war began. That record May premium reflected multiple simultaneous pressures: It reflected the genuine scarcity of Saudi crude reaching Asian markets through the only consistently available bypass route, the Yanbu terminal on the Red Sea, which has a capacity of approximately 7 million barrels per day that falls well short of the much larger volumes that previously moved through Hormuz under normal conditions. It reflected the willingness of Asian refiners, who were running short of crude and cutting their processing runs, to pay extraordinary premiums for guaranteed supply when the alternative was shutting down refinery units for lack of feedstock. It reflected Aramco's understanding that the supply disruption was acute enough to justify pricing at levels that the market would accept, because the option of not paying was worse than the option of paying and keeping refineries running. The May premium of 1950 was, as one industry source put it to Reuters, below the $40 premium over Oman and Dubai that some refiners and traders had feared in the most extreme supply scenarios, but it was still the highest Aramco had ever charged, and it had sent a significant shock through the energy cost structures of Asian refineries, from South Korea to India and from Japan to China's independent processing sector. The June price reduction of $4, bringing the Arab Light premium to $15.50 over the Oman and Dubai average, needs to be carefully understood against the backdrop of everything Aramco's pricing team was evaluating when the decision was made in early May. The company's analysts were processing several converging variables simultaneously, each of which pointed in a slightly different direction, and none of which provided clear, unambiguous guidance about how aggressively to reduce the premium. The ceasefire talks through Pakistani intermediaries had produced Iran's 14-point peace proposal in early May, and Trump's rejection of it before he had finished reading the full text, a sequence of events that together suggested a negotiated reopening of the strait was neither imminent nor impossible, a state of suspended diplomatic animation that made pricing assumptions in either direction commercially risky. Project Freedom had delivered genuine military success on May 4th, with American helicopters defeating 7 Iranian fast attack boats, American destroyers successfully transiting the strait under Iranian fire, and 2 American-flagged commercial vessels completing the first successful commercial crossing since the closure began. But the same day had produced Iranian missile strikes on the UAE, an attack on a South Korean cargo ship, and Iran's continued broadcast warnings that any vessel attempting transit would be destroyed, a pattern that made it abundantly clear the strait would remain contested and dangerous for commercial shipping well beyond the first day's operations. The International Energy Agency had announced what its executive director, Fatih Birol, described as the largest ever release of emergency oil stocks in the agency's history, with IEA member countries making 400 million barrels available to offset supply lost through the effective closure of the strait. This was a major injection of alternative supply that provided some relief to the markets, but could not, given the 90% reduction in commercial traffic through the strait documented by the House of Commons Library, fully offset the disruption's impact over an extended period. And OPEC Plus's remaining 7 core members had agreed on May 3rd to increase their collective quota by 188,000 barrels per day for June, a signal of intent to restore supply gradually and in an orderly way that Aramco's June pricing needed to be consistent with, even though the physical capacity to deliver the quota increase did not yet exist, while the strait remained closed. The $4 cut, rather than the $8 cut that the Bloomberg survey had forecast, was Aramco's answer to all of these variables simultaneously. Conditions are improving at the margins. Project Freedom is creating some limited transit capacity. The IEA release is providing some demand relief, and the diplomatic track remains alive. But the fundamental supply emergency is nowhere near resolved enough to justify pricing that assumes normal conditions are returning. The Asian buyers, who are the primary commercial audience for Aramco's official selling price announcements, were absorbing the June pricing with a complicated mixture of relief, residual concern, and the practical calculation of how to manage crude procurement in a market where the normal supply channels remained mostly closed. Japan's situation was the most acute of any major industrial economy. Japan obtains approximately 95% of its crude oil from Saudi Arabia, Kuwait, the UAE, and Qatar, and in normal times delivers roughly 70% of that supply through the Strait of Hormuz. With the strait effectively closed, Japan had been running down its strategic petroleum reserves at rates that government officials acknowledged publicly could not be sustained through the summer without a diplomatic resolution or a significant scaling up of Project Freedom's transit capacity. Japanese refiners had been paying extraordinary premiums for any Saudi crude available through the Yanbu Red Sea route, and had been aggressively purchasing alternative supplies from the Americas and West Africa at costs that were significantly higher than pre-war Saudi pricing. The $4 reduction in Aramco's June premium provided some financial relief, but did not address the underlying logistics problem of how to move adequate volumes of crude from Saudi fields to Japanese refineries, when the Hormuz route remained militarily contested. South Korea and Taiwan faced structurally similar challenges. Chinese independent refiners had been buying Iranian crude in defiance of the American naval blockade, with Treasury Secretary Scott Bessent citing their continued purchases as evidence that the strait had not been fully sealed, but they were doing so at logistics costs that were compressing their margins and at political risk that added a new layer of commercial uncertainty to what had previously been routine procurement decisions. Indian refiners were navigating the pricing environment with their characteristic commercial flexibility, seeking the cheapest available barrel from whatever source could deliver it, but were also experiencing the supply constraints that the closure imposed on all major Asian buyers who depended on Gulf producers for a large share of their crude supply. The IEA's emergency 400 million barrel release provided some statistical supply coverage, but the practical distribution of those barrels to buyers who needed them in Asian refineries through supply chains that had been disrupted by the closure was a logistical challenge as significant as the financial one.